Hey everyone, and welcome back to another video for today. So it's been one heck of a week. Meta, Microsoft, Amazon, Apple, PayPal, SoFi, they all reported. And so this is basically how we ended the week. These are the companies that are up and these are the companies that are down. Now in this video, I do want to talk about Amazon, everything you needed to know. You probably already know some of the things, but I'll cover everything you need to know. I also want to touch on the CoreWeave situation and then on the, comments that we got during the Brad Gerstner podcast with Sam Altman and Microsoft CEO Satya Nadella. Some interesting clips I'll have to show you, some arrogance there as well. But let's talk about all of that in this video. If you enjoy this type of videos, hit all the buttons, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And so Amazon up 9.6% to $244 per share on a Friday, $2.6 trillion in market cap. It's going to make its way, of course, to $3 trillion, 4 or 5 in the future. It's going to make its way to $300 per share, $400 per share in the future as well. Why did this happen? Well, it happened because of the exact things we've been talking about with regards to Amazon. Yes, of course, over the past 5 years, if you look at Amazon, stock is only up 62.6%, trailing the S&P 500. Over the last 3 years, it is now up 138%, and year to date, it is now finally closer to what the market is doing, but still underperforming. At one point, when we talked a lot about this, it was underperforming. It was down year to date. And so Amazon, what's the big deal? Well, the big deal is basically this. We've got what we predicted, Amazon AWS, Amazon Web Services, growth acceleration, 20.2% to reach just over $33 billion for the quarter. That's not all. We have margins, operating margins here have gone up from 32.9% to 34.6%. So we've got AWS, which dollar-wise is, this is a crazy business, all right? Crazy business. Over the last 12 months, you've got $125 billion or so. You've got margins mid-30s, insane performance. You've got here the remaining performance obligations also grew 22%. We're now at $200 billion. And that's not all, right? That's not all, because all the other business lines, online stores, physical stores, right? That has also grown 7-8% or so, has grown at those growth rates for about 5 years. Then third-party seller services. This is, by the way, over the last 12 months, a $166.83 billion business, growing 9.6% right now. Incredible. Then the advertising business. This is also a $64.6 billion business over the last 12 months, growing 20.6%. I'll continue. Subscription services. Last 12 months, $48 billion in revenue, growing 10.7%. It's insane. That's not all. AWS backlog reached a staggering $200 billion by the end of Q3. Now, this figure excludes major new deals signed in October, which alone surpassed the total deal volume for the entirety of Q3. This represents a huge guaranteed forward revenue stream, confirming sustained long-term demand for AWS cloud services. So again, major new deals signed in October alone surpassed the total deal volume for the entirety of Q3. They continued by saying they added over 3.8 gigawatts of power in the last 12 months, with plans to double its overall power capacity by 2027. An additional 1 gigawatt of capacity is expected to come online in Q4 alone, showing the urgency to meet the demand. We're going to talk about power in just a bit. Then, Rufus, Amazon's AI-powered shopping assistant, is on track to deliver over $10 billion in incremental annualized sales. Right? When we talk about all of these investments in AI, a lot of the questions is, of course, around this, the return on investment. And here already we've got, for one AI-powered shopping assistant from Amazon, over $10 billion in incremental annualized sales. The assistant has engaged 250 million active customers this year. Monthly users have increased 140% year over year. Total interactions are up 210% year over year. Customers utilizing Rufus during a shopping trip are 60% more likely to complete a purchase, a direct impact on conversion rate and revenue. And here as well, we can make the comparison to Meta, right? Here we have Amazon and Meta, both of them, of course, investing a significant amount of money, right, in CapEx, in OpEx as well, but in CapEx for this AI revolution. But here you can already see how these investments are helping the core business. For Meta, it's the algorithm, it's the advertising. Here for Amazon, it's thanks to the shopping assistant, converting browsing users into purchasers. Last thing here, the high margin advertising segment is expected to maintain its strong growth trajectory, leveraging full funnel offerings and major new partnerships such as Netflix, Spotify, and SiriusXM. And so, yes, with Amazon, you've got, in my opinion, still one of the best, if not the best company to just buy and forget. I've talked about Amazon for a long time. I've owned Amazon in my retirement portfolio since 2018. It's the number 2 position there after Meta. And yes, it is one where when we see big dips, especially for the wrong reasons, you add more. It's very simple. It's an amazing business. It's a business that keeps on expanding its total addressable market, right? Advertising was not really a big thing or a thing for them a couple of years ago. I mean, of course, when they started, it was just books and things like that. But over the years, yes, they added the AWS, right? The business, the huge business for them, which also back then people were laughing at Jeff Bezos. We're like, why the heck do you even need this? Stay in your lane. Well, they didn't stay in their lane, and now they became a huge company. It doesn't stop there. They added Amazon Pharmacy. They have Project Purpose. All of these things expand Amazon's total addressable market. And yeah, I don't even think the end is near here. Now, I don't know if a lot of you remember, but during the live stream before Amazon reported, the implied move was around 6.7% or so. And so in the live stream, we drew 6.7% from that time on the way down and on the way up. As you can see, on the way up, it reached $243, actually closed the week at $244. So was quite accurate. Yes, it did go up a little bit more, right? It did go up a little bit more, but we closed out here at $244, up around 7.4%. Congratulations to everyone that have been buying Amazon over the last couple of weeks, especially when it dropped here under that 50-day moving average closer to $210 or so. Then what I want to talk about are these following 2 clips from the Brad Gersner podcast with Sam Altman and Satya Nadella. So let's hear them out.
They have more GPUs. You know, I asked Jensen on this pod if there was any chance over the course of the next 5 years we would have a compute glut. And he said it's virtually non-existent chance in the next 2 to 3 years. And I assume you guys would both agree with Jensen that while we can't see out 5, 6, 7 years, certainly over the course of the next 2 to 3 years for the reasons we just discussed, that it's almost a non-existent chance that you have excess compute.
Well, I mean, I think the cycles of demand and supply in this particular case, you can't really predict, right? I mean, even the point is, what's the secular trend? The secular trend is what Sam said, which is at the end of the day, because quite frankly, the biggest issue we are now having is not a compute glut, but it's a power. And it's sort of the ability to get the builds done fast enough close to power. So if you can't do that, you may actually have the secular trend is what Sam said, which is at the end of the day, because quite frankly, the biggest issue we are now having is not a compute glut, but it's a power. And it's sort of the ability to get the builds done fast enough close to power. So if you can't do that, you may actually have a bunch of chips sitting in inventory that I can't plug in. In fact, that is my problem today, right? It's not a supply issue of chips. It's actually the fact that I don't have warm shells to plug into.
Okay, so interesting comments here, right? And again, he talks about Microsoft and probably also OpenAI, doesn't talk about the whole industry. His problem is not chips anymore, the GPUs, it's not that. The issue is that he has GPUs, chips, but he needs to plug them in, right? He needs the power. He needs the data center to be available to put these chips in them. That's something that we've also been talking about, what? When we talked about Iron, when we talked about CoreWeave, when we talked about Nebius. You need the power. But also when we talk about those, it's important to know that you also need the GPUs. Now, of course, in Microsoft case, you can now add the puzzle pieces together. If they did have all of the GPUs, but did not have the power, the data center, somewhere to plug them in, you now understand the deal that they have with Nebius.
And so how some supply chain constraints emerge, tough to predict, because the demand is just going, is tough to predict, right? I mean, I wouldn't, it's not like Sam and I would want to be sitting here saying, oh my God, we're less short on compute. It's because we just were not that good at being able to project out what the demand would really look like. So I think that's, and by the way, the worldwide side, right? It's one thing to sort of talk about one segment in one country.
Now, I do want to point out one other thing that Jensen said, I think last week or 2 weeks ago, that it doesn't matter where you're building the data center, you will have to build where there is the power, where there is the energy. Because everything that you're doing, all of the training, all of the data that you're getting, the inference as well, all of that can be done somewhere around the world where the power is available, when the energy is there. And then the results, all of the data, the answers, those can be transferred worldwide. So it's not like they're stuck to build just in the United States. That's probably why we're seeing already a lot of things in the UAE, in Saudi Arabia, because guess what? There is a lot of power, there is a lot of space available there as well. Now, the upcoming clip is one where, I don't understand Brad's reaction. Brad is the guy here on the screen. Second of all, the arrogance of Sam Altman is here on full display.
Hanging over the market is how can the company with 13 billion in revenues make 1.4 trillion of spend commitments? And you've heard the criticism,
First
Sam.
of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer. I just enough. People are. I think there's a lot of people who would love to buy OpenAI shares. I don't think you would,
including myself. Including myself.
People who talk with a lot of
Two things here. One, what an arrogant response by Sam, especially since it comes from Brad, who invested quite a lot of money into OpenAI. Second of all, Brad's response. I mean, if this guy had a little bit of respect for himself, he would have responded with something else to Sam here. Like going to defense here, oh, I would like to buy even more shares, please don't make me sell. Seriously? Seriously? He just called you out after you just asked him a simple question, a question that the whole market is asking. You are one that probably invested hundreds of millions, if not maybe billion, I don't know, into this guy's company, and this guy is literally laughing at you, threatening you, because he does not want to answer your question. Oh yeah, by the way, it never answers the question. So let me actually show you the whole clip.
breathless concern about our compute stuff or whatever that would be thrilled to buy shares. So I think we could sell, your shares or anybody else's to some of the people who are making the most noise on Twitter, whatever, about this very quickly. We do plan for revenue to grow steeply. Revenue is growing steeply. We are taking a forward bet that it's going to continue to grow, and that not only will ChatGPT keep growing, but we will be able to become one of the important AI clouds, that our consumer device business will be a significant and important thing, that AI that can automate science will create huge value. So, there are not many times that I want to be a public company, but one of the rare times it's appealing is when those people are writing these ridiculous OpenAI is about to go out of business and, whatever. I would love to tell them they could just short the stock, and I would love to see them get burned on that.
I think he saw an Alex Karp video just before this interview and he thought he's him. Unfortunately, he's not.
We carefully plan. We understand where the technology, where the capability is going to go, and how the products we can build around that and the revenue we can generate. We might screw it up. Like, this is the bet that we're making, and we're taking a risk along with that.
Yeah, we might screw it up. And again, you failed to answer a very valid question from one of your biggest, I would say, investors. Moving on to CoreWeave and Core Scientific. So the deal is not going through. Okay, the deal is not going through because Core Scientific shareholders voted against the deal. We respect the views of Core Scientific stockholders and look forward to continuing our commercial partnership. CoreWeave's strategy remains unchanged. We will continue to execute with discipline against our roadmap to create long-term shareholder value, including through opportunistic and strategic M&As. For those that don't know, back in July here, CoreWeave, of course, put in a bid to acquire Core Scientific. Through the acquisition, CoreWeave will own approximately 1.3 gigawatts of gross power across Core Scientific national data center footprint, with an incremental over 1 gigawatt of potential gross power available for expansion. Now, this deal, of course, comes after both of them already had a contract, a partnership, whatever you want to call it. Now, the financial impact of this deal would have been this: immediate elimination of over $10 billion of cumulative future lease overhead to be paid for existing contractual sites over the next 12 years. So now that the acquisition is not going through, they're basically going back to what was before, July 6th. Now, including the elimination of the lease overhead, this deal adds $500 million of estimated, or would have added $500 million of estimated fully ramped annual run rate cost savings by the end of 2027 through streamlined operational focus. Now, this will not happen unless maybe they acquire another company and maybe they find something interesting there, but this is not going to happen right now. To me, this smelled like greed from Core Scientific shareholders, but then again, they hold the shares, they make the decision. I think CoreWeave is going to do quite well without owning Core Scientific. Now, another thing that went under the radar, I think, is this: CoreWeave to enter the US federal market. CoreWeave is going to pursue FedRAMP and other authorizations to bring the essential cloud for AI to US government agencies and the defense industrial base. I think once they get access to that, we could potentially be seeing huge government contracts coming CoreWeave's way, or maybe coming Microsoft OpenAI's way, then flowing to CoreWeave. Definitely possible. And so to conclude this long week, actually, great week, all in all. The companies that we follow and we covered reported quite good earnings reports. Stock reaction can fluctuate. This is exactly what we've seen actually throughout the week. Stock reactions can fluctuate, and that's fine. What's the most important is, of course, good report, good numbers, good commentary on a guidance, and in my opinion, that's what we've got. Share your thoughts down in the comment section below on Amazon, on the Brad Gerstner podcast, on the CoreWeave situation. See you all in the next one. Bye-bye.